Well. Long time no see, my friends. How's everyone doing? Happy Tuesday. I know live stream on a Tuesday, kind of a random thing. It's been I guess a couple weeks now that I've done a live stream, and there are times where I'm just like sitting around and I want to, I just kind of get an itch to start live streaming. But the thing is, and this might sound silly, but the thing is I don't always want to, you know, how do I explain it? I don't always want to brand it as like a dividend happy hour. I feel like that's just for Friday night. So I figured I'd come up with something different, and that's what we've got today. So I don't think this will be a regular thing. I see, let me pull it up. Saw Lucas's chat right here. Is this going to be a regular thing? I don't know that it will be regular necessarily. It might be semi-regular or irregular. It'll be a somewhat normal occurrence, I think. Basically, with all of that said, whenever I get the itch to hop on and live stream with you guys, it'll be something like this. Just hop on, take some stock requests. We'll, dive into them, see what they look like on Snapstock, and just have some fun. So I think we're going to go. I started a couple minutes early. I think we'll run it for about 30, 40 minutes or so, maybe a bit longer. We'll see how the stream goes, and we'll go from there. But anyway, I hope everyone's doing well. Hope everyone's having a great day. And with that said, too, I see you guys already doing this. If you have any stock requests, drop them here in the live chat. I don't know if we'll get to every single one, but for each one, we'll pull them up on Snapstock. We will go through the financials, go through the charts, and see what there is to see. Yes, Steve says this will help from the DHH withdrawals. I agree, and I'm sorry. Like I said, it's been a couple weeks. I missed last week. I missed the week before that. We will be live streaming this Friday night. We will be doing a dividend happy hour this Friday night. So for now, we should be back in action, at least until the baby is born, which really could be any day, which is pretty wild. But yeah, it really could come at any time now. My wife just, I won't ramble too much more on this, but my wife is officially on maternity leave starting yesterday, which is cool. So it's coming down to it. But before we get into some stocks, guys, let me show you where the portfolio is at today. It's middle of the week, second day of the week. The market just closed about an hour ago. And this is where we ended up today. Let me know in the live chat real quick right here. Let me know if you were up today. Let me know if you were down. What were some of your best and worst performers? I want to hear what's going on with you guys. But this is where we finished up today, up just barely, just 0.1%. And I have dipped back down below 110K here in the portfolio. So we are seeing a bit of a pullback from recent highs, which is totally fine. I've been talking about this a bit more recently. I feel like, it's probably about due for a slight little pullback. And I certainly don't mind it, because as of late, it has been pretty tough to find things that I want to buy. And as you can see, I've been building up a couple grand worth of cash right here in the portfolio, and we'll continue to do so until I see something that I actually want to pull the trigger on. But that's what's happening with me, guys. Let's go. Can we do a revisit to Vici? Yeah, let's go. Let's scroll up here in the top, see some of these. I'm just going to kind of pick them out, pick out the ones that jump out to me. Let's start with this one right here. Let's start with Domino's from Joseph. He wants us to look at Domino's. So let's go over to Snapstock. Let me add, how do I do this here? Okay. So let's jump over here. And then, by the way, guys, you can start using this platform. This is what we're going to be using for all the stock analysis, all the stock research. You can start using this for your own stock research. Right now, there's a link to it in the description of the video. I'll put it in the pinned comment afterwards as well. But right now, you can find it in the description if you want to check it out. Okay, so Domino's. Let's start here with the share price performance. Year to date, the stock is down a little bit. It's down 1.75%. As far as the snap score and red flags go, it looks like we're seeing a few red flags. So we'll look into that and see what's going on there. Snap score is at 6.2. Not a bad score. Looks like the debt situation may be a bit questionable. We'll see what's going on there. Profits are going to be, or the profitability, the margins are going to be kind of average. It's okay. Very solid growth. very solid capital efficiency, good looking dividends and buybacks. So let's check it out. And it looks like this is kind of interesting. So the PE ratio in the trailing 12 months is about 24.5. For a company that's historically been as growthy as Domino's is, that might not be a bad PE ratio. And it's 20% below the 5-year average. So, that looks okay. And historically, I mean, the last couple of years, we can see it's been a bit higher. So let's scroll down. So in the growth department, this is looking really good. It does look like the growth has kind of started to slow down in these last few years. The 5-year growth rate's only 5.4%. Decent growth, but definitely, not as good as it's been over the last 10. So the earlier part of this last decade, we did see more aggressive growth in sales. So it has kind of moderated a bit. Earnings per share and free cash flow per share still looking pretty good. We're still getting double-digit earnings growth, and the free cash flow growth over the last few years has settled a little bit as well. Looks like these last 3 years, it's kind of, it's been a little bit, what's the word I'm looking for? It's been a little bit choppy. I think that's the word, but still the overall trend is up and to the right. So I think that's looking good. And as far as the margins, I mean, the score was what, a 5.4 out of 10. But I don't think they're that bad. I mean, they're pretty consistent. The gross margins are pretty consistent, actually slightly increasing since 2018. Looks like the net profit margin has been increasing as well, going from, below 8% a decade ago to now about 12.5% in the most recent years. So definitely some improvement there. And the free cash flow margin has been steady as well. So I think that's looking good. Now, scrolling down to the debt, this is where we see the first couple of red flags. So it looks like they have about $4.9 billion of net debt in the trailing 12 months. Okay, is what it is. But the net debt to free cash flow is a bit on the higher end. In the trailing 12 months, it's 8.5. My threshold that I look for is typically about 5 or below. For a normal company, if we're talking a Domino's, a Procter & Gamble, a Coca-Cola, normal, straightforward companies, net debt to free cash flow I like to see is about 5 or below. This is way above that. But it looks like that's pretty normal for Domino's. And I would imagine most of this debt, if not all of it, is long-term debt. So, it's probably not the end of the world. It is something to keep in mind. And like I said, it is a bit above where I'd like to see it. So I would say that is a red flag for me for sure. The interest coverage as well is a bit low, too low for my liking. I look to see, like it says right here, I look to find an interest coverage ratio that's about 8 or above. But for Domino's, it's about half that, and historically has been so, right? We can tell from the chart that the interest coverage has been about 4 and above. So it always sits pretty low. So I think that's something to consider too, even though, I have my thresholds, I have my rules of thumb that I try and look for. You also have to take into context what's normal for the company in itself. And it looks like a lower interest coverage is pretty normal for a company like Domino's. So maybe it's not as big of a red flag as it could be for other companies. I don't know. Let me know what you guys think about that in the comments, because that's just my take right there. And real quick, I want to take a pause. I do see a super chat here from Steve. Are you and thank you for the super chat. Do you buy any AI, quantum, robotics, or drone stocks? No, I do not. I'm not in any AI, quantum, robotics, or drone stock. So in case this is, I'm sure all of you guys are familiar with my channel already, or most of you guys at least. But if this is your first time tuning into the channel or tuning into a live stream, I'm a diehard dividend investor. All of the stocks in my portfolio are dividend paying stocks, which typically you're not going to find those in the AI, quantum, robotics, or drone industries. So yeah. But thank you for the super chat. I really appreciate that. Anyway, getting back to, where were we? Domino's. We're in the dividend stat. So starting yield is going to be a bit lower, which is not too surprising considering the growth profile on this company. Okay, very growthy. Typically, when we see companies increasing their sales, earnings, and free cash flow like this, it's not going to be too surprising to see them come with lower starting dividend yields. But we like to think that they make up for those low starting yields, which for Domino's is 1.4% in the TTM, which actually is quite a bit above the 5 and 10-year averages. So, from a valuation standpoint, that is a good sign. But we like to think that the dividend growth rates make up for the lower starting yields. In Domino's case, the dividend growth has been very impressive. Over the last 5 and 10 years, it's really not too different, between 17 and 20% in both departments. So I think that's looking good. And it's actually consistently been that high as well. There have been a couple of years where it's dipped down a bit lower, like 2023 here, where it was below 10%. But otherwise, the dividend growth from Domino's has been very impressive. Along with that, though, we do see a couple more red flags coming here in the payout ratios. So, and this is interesting. So the reason that it's showing some red flags right here, at least for the earnings payout ratio, is because the company is paying out a significantly higher percentage of its earnings than it usually does to the dividends in the most recent year. So in the trailing 12 months, earnings payout ratio is about 40%. The 5-year average is about 10% below that. So when a company is paying out more than they usually do, that could be a red flag. That's why we're seeing that here. And we do see that the trend since 2021 has been a growing payout ratio. Now, if this continues to play out, that could be concerning. But at this point in time, considering the payout ratio is still less than 40%, it doesn't seem that Domino's is at risk of cutting their dividend or having to cut their dividend anytime soon. So yes, technically, it's calling it a red flag, but it's really not that big of a deal. It is something that you'll want to keep an eye on if you are a shareholder or a potential shareholder, just to see how this trend continues to play out. Because if it continues to go up and up and up and up, then at some point, this dividend growth rate will slow down. You won't be seeing 20% dividend increases, 15% dividend increases, or 25% like in 2024. You'll start to see lower dividend increases. And probably one of your reasons for buying into a company like this would be for its aggressive dividend growth. So that is something to keep in mind. It's probably a bridge that all companies do have to cross at some point. Maybe Domino's will get there soon. Maybe it will not. We'll just have to see how the earnings and free cash flow continue to grow, because it really is dependent on that. But going over to the free cash flow payout ratio, seeing a bit of a similar trend there. In 2024, the payout ratio is still very low, about 41%. And this is very cool. They are a buyback machine. I mean, look at this chart, the shares outstanding chart. It's gone from 55 million, shares outstanding in 2013 to 34 million in the trailing 12 months. So just in the last decade, they've bought back, 21 million shares. It's pretty crazy. Whew. Let me take a sip, guys. Nick, this is not a Rolex. This is a $100 bull of a watch. Very strong returns on invested capital, 50% and above. So that's really good. And also that comes, you'll see this a lot with companies who operate on a franchise model. It's not uncommon to see these higher returns on invested capital. So anyway, what do you guys think about Domino's? Is it a buy? Is it a hold? Is it a sell? You guys interested in this company at all? What do you think about it? Also, Nick, here's for you. Little bowl of this was my uncle who passed away. This was his watch. He got this watch for his 30th anniversary working with Chevron. So I call it my Chevron watch. But yeah, this is probably $100, really not anything crazy. But the cool thing is this watch is about 25 years old. Compounding Oak does not own Domino's. No buy. Nick says no buy on Domino's. I could buy cheaper stock rather than Domino's with a higher dividend yield. Okay. Let's see. Boaz, not interested. Chris, not at all. Lost Jonas. For me, it's a hold, but I've been dollar cost averaging down. Let's see. Yeah, Nathan says I'd rather go with McDonald's over Domino's. I probably would too. Although I will say McDonald's has been getting pretty pricey. The value proposition with McDonald's, I think, is fading away. And I think Domino's still has a very, very strong value proposition. Like when it comes to getting a burger these days, you're better off going to somewhere. I was actually just talking to my wife about this yesterday. She door dashed for her parents just to do something nice. She door dashed for her parents McDonald's, and DoorDash was running some incentives, so there was a bit of a discount. There was, she got a little bit off from it, but just for like 2 cheeseburgers and an order of fries, large fries, it would have been, without the incentives, about $20. And these incentives included like free delivery, all that stuff. So this was basically just the pricing for the food itself, and there was even probably a little bit of a discount on that. But without that, yeah, it would have been about $20, which is pretty crazy. You can definitely get like more than one full size pizzas from Domino's for even less than that. But like I was saying, you're better off going to somewhere like Chili's or Applebee's or Red Robin. Like Red Robin, once a week they run a special where you can get like their Red Robin Tavern burger, which is like their smaller size double cheeseburger, bottomless fries, and a drink for $10. That's the special. So, you can get 2 orders of those and still be coming out probably less than what you'd spend at McDonald's for something similar, and a better experience as well. Let's see. Kevin Burgess in the building. What's up, Kevin? I don't own Domino's. Doesn't seem to be compelling for me. I get you. Yeah, Christian says, I would pick one with the same upside but less risk. Boaz says no moat. Okay. Yeah, so next, Nick wants us to cover Target. I think that'd be a good one to get into. Target's a pretty interesting one because Target, I mean, that stock, the share price just cannot catch a break. So let's go scroll up, go through Target, see what we're rocking with. Sticking in the same sector, Target is also in the consumer discretionary sector, I believe. No, actually, it's in the consumer staples sector, excuse me. But it can be, I personally think it can be considered a discretionary company. Although they do sell groceries, I think groceries is a relatively smaller part of their sales compared to other stuff like clothes or furniture or electronics and stuff like that. So they sell a lot of discretionary products. But anyway, getting back to, just getting into it, I should say. The share price, like I said, very, very low. We're looking at $87 per share, which is about half of what it was this time last year. And just looking at some of these time periods. So just in the last month, the stock is down another 10.4%. Year to date, Target is down 35.25%. It's just pretty unreal. In the last year, it's down 42.7%. So it's definitely looking cheap, right? PE ratio is almost single digits, 50% below the 5-year average. Free cash flow yield is incredibly high at double digits. So right off the bat, I think if you're looking for, and let me mention, excuse me, it's right there at its 52-week low. So with that said, I think if you're looking for a cheap stock, you just want a cheap dividend payer, Target could be a good one to consider. If that's all you care about, something cheap with a nice yield. We can see that in the trailing 12 months, or right now, the yield's coming in at about 5.1%. If that's all that matters to you, then, Target could be worth considering. Now, looking at everything else, 4 red flags. We'll see what that's about. The snap score is coming in at about 6. So this is looking to be an average company. It's not going to be, knock your socks off out of the park as far as, quality goes, or, being an above average business, but it's not all bad. It's not all good. It's kind of somewhere in the middle. Growth's kind of average. Profitability is a bit low, which is not too surprising. You'd see similar profitability scores from something like a Walmart's or a Costco for sure. And that just kind of comes with the territory of this type of business. It's not necessarily a bad thing, even though it does result in them having a low score. But yeah, it just comes with the territory of these retailers. Debt's looking pretty good. Dividends and buybacks good. Capital efficiency very strong. So like I said, it's not all bad. And if we scroll down here, this is where I don't quite know. I don't quite know what to think. Interesting. So I'm just reading the comments. Sorry, guys. Okay, so let me know what you guys think of these growth charts. Okay, because for the most part, over the last decade, there has been growth in sales. Since 2023, looks like sales have taken a bit of a pullback. Um, so we are seeing a bit of stagnation here in the sales. I think that's something uh, from a long-term investor standpoint, that is something that does concern me to see this trend, this stagnation, this even slight pullback in sales. Not to say that they can't get back to growing the sales, but I'm not sure what the catalyst for that would be right now for them. So that's one thing. The earnings per share growth, I mean, they did it really well during the pandemic years right here. But since then, it looks like the earnings per share and also the free cash flow has kind of come back down to earth. Still, though, if you take out these 2 years, actually, yeah, if you take out these 2 years and just continue the trend from here, it's still, the earnings per share is still growing. So I don't think it's all too bad. Free cash flow as well. I would say the same thing. There was a bad year here in 2023. But it's not terrible, Excuse me. So I don't know. I don't quite know what to make of this. Especially if they plan on continuing to increase the dividend. And Target is a dividend king. We'll see what the payout ratio is looking like. But at some point, if the earnings and the free cash flow do not get back to growing, we'll see those payout ratios continue to go up. And at some point, that will become a problem. Let's see what the payout ratios look like in just a moment, though, and see where things are at. In the meantime, looking at the debt situation, looks like there was a decent jump here in the trailing 12 months. But still, it's not in terrible shape. The net debt to free cash flow is 4.6. So that's below our threshold of about 5. Looks like the interest coverage ratio is still high at about 12.7. So, that kind of, checks the box for us as well. So I think the debt situation's looking good. So we've got, okay, kind of questionable growth. Debt's fine. Dividends and buybacks. Well, we can see the payout ratios right there. It's really not too bad. We'll get more into that in just a moment. Interesting, guys. So the starting yield's 5.1%. Really, really nice, and clearly way above the average. The dividend growth historically has been nice too. It's actually been more aggressive over the last 5 years than it has over the last 10. But it is kind of slowed in recent years. It looks like the big, how do I say this? The big thing contributing to, or the couple of years contributing to this big CAGR would be these years right in here. But I think since 2023, we do see it start to slow down, but still not bad. In 2024, it was still almost a 10% increase. So I don't know. I would be surprised if they continued to raise the dividend this much in the coming years. Now, with that said, the payout ratios for now look to be fine. Still about 50% in the trailing 12 months, 42% as far as the free cash flow. So I think that looks fine. And they've been they've done a really good job of buying back shares. And I wonder, yeah, it looks like they're still kind of buying back shares over these last handful of quarters, which is great. Now is a good time for them to be buying back shares. So it is good to see them do that over these last few quarters. Now, scrolling down, look at the returns on invested capital. They're okay. They're not too bad. We're getting double digits on average over the last 5 and 10 years. So, yeah, I think that looks pretty good. I think that there's some things to like about Target. The one thing that does give me a bit of pause, actually, I would say the only thing that gives me pause with Target right now are these 3 charts right here. We're really not seeing, I feel like we're seeing a lot of stagnation. So, like I said, that gives me a bit of pause. And if you guys have any more insight into this company, maybe if you spent some more time with it, let me know what you think about this company here in the chat. I want to see if you guys have any thoughts here. Let's see. Nick says Target will be a guaranteed 2x. Mr. Crystal Ball over here. I hope you're right. I would love to see this company do well, because it is a it's been an iconic company. It's a dividend king. It's got a lot of good things going for it. So I'd love to see this this company do well. The same true for all dividend payers. Fast Eddie says, "Do you think Target will ever make it back to $100 a share?" Yeah, I don't. I would be surprised if they didn't. I mean, you know, we're looking at these charts right here. Target's been around for a long, long time. I don't know. I think they'll find their groove. They should find their groove. Christian says, does the snap score take into account sector? Because I know some sectors are way more debt inclined than others. No, and not at this point in time. It doesn't. We haven't gotten that far with it. In time, it would be cool to make it sector specific, so it knows to assign or to measure it differently based on the sector. But no, at this point, it's just how do I say it? It doesn't take into account these specific sectors or whatever. But even within sectors, companies will have, you know, totally different scores. So. Oh, interesting. Fast Eddie says, I will not be surprised in 10 years if Target does not exist. Nick, if you could just if you go in the description, it's the very first, the description of this video. It's the very first line right there. Let's see. Yeah, Lost Jonas says, to me, Target is a retirement stock at this price because of the high yield and not expecting it to go much lower than 85. Yeah, that's a good point. I would say, yeah, I would agree with that. You know, it's historically been a very steady dividend payer, dividend grower. Like I said, it's a dividend king. Very nice high yield right now. We'll see if the appreciation comes back. I feel like it's just, man, I feel like it's priced so far below the average that there has to be some sort of return to the average at some point. So if the law of averages does come into play here and it does kind of revert to the mean, then I don't think the law of averages, I think that's incorrect. But if there is a mean reversion, then Target should see some appreciation just because of that. So, Dan, this is a great question. Is now a good time to buy Rollins? We will take a look at Rollins in just a moment here. I want to get caught up in the chat. But yeah, we'll take a look at Rollins. That's a great one. So continuing on with Target though, let me pull this off the screen. Doe here, MDoe says, Target does not seem to have the same online presence as Walmart does. Walmart has taken almost an Amazon approach to its online sales. Yeah, Walmart's done a really good job of doing that. Fast Eddie says, Target is like my hair. In 10 years, it will be gone. Man, my hair, you know, all summer I was rocking that basically the no guard buzz, but it's growing out pretty nicely. You know, we've got a little coif in there. It's actually getting a little bit too long. But see, you can see it sticking out through the fingers there. It's about finger length on top. But yeah, it's hanging on. It's hanging on. Target has to win back a customer base first. Yeah, and I think maybe that's that. Well, I think I know what you're referring to. Nick says women love Target no matter what, especially during the holiday. Yeah. Moj says Target will still be around in 10 years. Look at the history. Been around a long time, made it through hardships, has a moat that most don't acknowledge. I would be curious to know, though, what is that moat? What is that moat for Target as you see it? Sam says Walmart and Costco are better companies, but they're both overvalued at this point. Yeah. Oh, it's not disrespect. He's just joking around. I think you're referring to the hair. Nah, he's cool. He's joking. It is kind of a running joke here on the stream because usually I got a very tight buzz on top that makes it look like I'm balding. But my man Nick's here. Target margins are thin, debt is high, dividend growth is slow, competition stiff. Maybe could make some money in the short term or lock in a high yield, but don't expect much dividend growth. Yeah, I mean, competition is one of the things one of the other things that keeps me at bay, and maybe that's what we're seeing here in the stagnating sales. The competition is just kind of taking over the Walmarts, the Amazons, the Costcos. So Moj says, as far as the moat goes, the moat is the city locations. Walmart could never and would never build an inner city grocery store with elevators and a parking garage. It just isn't their business. I'm not, I'll be honest, I'm just not entirely sure how that is a moat, how that is a competitive advantage. And I might get this stat incorrectly, but I think like Walmart, like you can't go like everyone in the United States. I might have this slightly wrong, correct me in the chat, but I remember reading or hearing somewhere that every person in the United States is within 10 miles from a Walmart. Something crazy like that, to where there's basically a Walmart in arm's reach of anyone. Um, I could totally have that a little bit incorrect, but I remember reading something like that. Christian says, I think Target is more of an old company that will now stay as a value company that will have a slow death over a few decades. Perhaps. It's definitely an old company. And, this could be just part of the business life cycle. Definitely a mature business. And, sometimes when businesses reach this point, they get to this point where there's almost no more juice they can squeeze. And that's when you start to see the stagnating growth. They could, as far as the earnings and free cash flow goes, they could and probably are. I don't know enough about it don't pay enough attention to it to know what cost efficiencies they're making, but they could work on the margins. It does look like the margins have kind of declined over the last decade. But if they can tighten things up there, tighten up the budget, they could see more earnings per share growth and free cash flow growth, but even with declining sales. So we'll see what happens there. That would be a page out of something like Altria's playbook. Okay. That is true, but you need a car to access those Walmarts still. I don't know that I quite understand this point. Like, I need a car to go access my Target. It's not like Target is within walking distance of everybody. I would say that in most cities, or in many cities, maybe not most, because I haven't been to most, but I would say in most cases, if you're going to the grocery store, you're driving. I would say that in fact, in most places you go, if you are traveling, you're more likely to have to drive there than you are to walk there. Okay, let's see. I think I want to get caught up here so we can move on to Rollins. Okay, so guys, we'll go on to Rollins. Maybe we'll go through one or two more and we'll wrap it up. We're about 30 minutes into the stream, making some good headway. And I want to say too, real quick, thank you so much. Thank all of you guys so much for tuning in. Yeah, thank all of you guys for tuning in. I hope you enjoy this stream. Like I said, I don't know that this will be a regularly scheduled thing, but whenever I have an itch to just hop on and live stream and hang out, this is what it'll be. We'll just hop on and talk about some stocks. So let's go back over here. Let's get into Rollins, which is my great white whale. This one has been teasing me for so long now. Okay. Ooh, what about Tractor Supply? Way more fur. I like Tractor Supply. I think that's a great company. So as far as Rollins goes, the share price has seen a little bit of a pullback. Way more fun than Target or Walmart. That's true. But anyway, as far as Rollins goes, a little bit of a pullback in the last month. They were getting pretty close to $60 a share not too long ago, but now they're sitting in the mid 50s. I saw it yesterday, or maybe this was Friday, but I saw it pretty recently, actually, under $55 a share. Nonetheless, in the last month, it's down about 3%. Year to date, Rollins is still crushing it, up 21%. At the start of the year, it was $45 per share. Gosh. Over the last year, it's up even more. Well, I guess not, actually. It's only up 10%. Where was the pullback here? Okay. So I guess it was heading into the year close to $50, but then it did see a bit of a pullback, getting down as low as 45 at the start. But anyway, looking at some of the valuation metrics, the PE ratio for this company is 55. 55 PE ratio. That's just crazy. Free cash flow yield is very low at 2.35%. None of this is surprising, just considering what the share price has done. Excuse me. This is one of those that it just only seems to go up and up and up. And I really wish I would have just bought it right in here, kind of around when I was first talking about it. I just wish if I go back in time, that's definitely one thing I would do. So anyway, that's what's happening with the share price. Forgot to look at the red flags. 3 red flags, very high snap score though. The highest I think we've seen all day, right? 7.9. Very strong from top to bottom. There's really not a bad score. Looks like dividends and buybacks is getting the best score out of the bunch at 9.2. But anyway, if we scroll down looking at the growth charts right here, I mean, what more could you ask for with this? And real quick, I should have mentioned, in case you don't know what this company is, Rollins, ticker symbol ROL. This is This is a pest control company. So if we go over here, maybe it'll tell us a little bit more. It's a pest control company that pest control services to residential properties and also commercial properties as well. And if you go over to their website, they've got a ton of different pest control brands that they have acquired over the years. And the thing is, they don't always, buy something up and then rebrand it to something else. They typically leave it the same. Like I remember when I was growing up in a small town in California, Clark Pest Control was the big pest control company in our area. Come to find out, they're owned by Rollins, but you never know it. So they own all these different pest control companies. Orkin is the big one. It started out as Orkin, and somehow Rollins came into the picture here. So, but anyway, going back to it, as we saw, very strong growth. And the thing about pest control is it's a recurring service. Typically when and I'll tell you what, when we moved into our home here in Vegas actually about a year ago, almost to the day, a year ago, I think we moved in on September 24th. For months after we moved in, from the time we moved in and months after, it seemed like every single day we were getting solicitors coming to sell us on pest control. And those guys were relentless. And typically the interesting thing, it was almost a different pest control company every single time. So that's another thing to keep in mind. This industry is very fragmented. It's pretty easy to just, set up a one-off pest control company. You just need you need a truck, you need the pest control, I don't know what you call them, the chemicals or whatever you need to do to actually operate the service. But typically you're locked into services and they'll come every quarter, every couple months. So it is a recurring revenue generating business, which is really cool. And that's pretty much why we see this up and to the right. So recurring revenue, very high retention rates on those customers. And so they've done a great job growing. Part of it's our organic growth, part of it's acquisition, these tuck-in acquisitions that they do. And that trickles all the way down to the bottom, both in the earnings and the free cash flow. And as we'll see, it also trickles down into the dividend. Now, scrolling down, looking at the margins, very, very consistent. High gross profit margins, about 50%. That's very solid. It looks like actually the net profit margin has increased over the last handful of years. And we see a steady increase in the free cash flow margin going from 10.5% about a decade ago to what is it, about almost 18% actually in the trailing 12 months. So that's quite an increase. Scrolling down, it looks like there was a big jump in debt. Definitely, probably, I shouldn't say, I'm pretty sure it's acquisition related because they tend to do a lot of acquisitions. So big jump in debt here from acquisitions. With that though, it only took the net debt to free cash flow from 0.55, which actually means that if the net debt to free cash flow is less than 1, it means they have more free cash flow coming in per year than they have net debt on the balance sheet. So it went from 0.5 to a mere 1.4, and it's since coming back down as well. So now it's almost back down to 1 in the trailing 12 months. So even though there was a big jump here, it's all good. It's still very manageable. Debt's very serviceable. Balance sheet is still very clean and conservative, just how we like it. With that said, getting into the dividend stats, lowish starting yield, 1.1%. So one of the lower yields that we've seen today. With that though, the dividend growth has just been phenomenal and consistently very good as well. Almost 20% on average over the last 5 years. So that's looking good. And some years we're getting like 30% increases, right? Like 2021, it was 30%, 2023, 25.5%, 14% in 2024. So very solid there. And the payout ratio is pretty consistent as well. It's a bit on the higher end, about 60% for the earnings payout ratio. The free cash flow payout ratio is actually a bit lower, 50%. So the dividend is still very well covered. This is consistent, plenty of room there, plenty of wiggle room there. And it's probably like a company like this can get away with having a higher payout ratio because the sales and the profits and everything, it's so predictable, it's so consistent, that I think they can get by with paying out a bit more to their shareholders. And also, while at the same time, like, I don't know, I think they're doing a pretty good job of allocating capital between paying out the dividends, rewarding shareholders that way, but also still being able to make these acquisitions around the country and around the world that continue to grow the business. So yeah, I'm just so stoked on this company. It checks all the boxes for me, and also very high returns on invested capital. So like on average about 20% over the last 5 years, and also 10 years as well. So you can see, I think you can see why, why I think this is one to own. But it's also, with all of that said, it's no surprise to see this as one that is certainly priced at a premium and continues to just go up and up and up and up. So, and this is where you get into the question, is it a good time to buy Rollins? And I don't know. I still have a very hard time pulling the trigger on it. I'm not sure, even though it is a high quality business and it's one that I really want to own. I'm not sure that I want to pay for it when the PE ratio is at 55. I'm not sure I want to pay for it when the free cash flow yields at 2.35. I think that there's probably more attractive and also other high quality companies out there. I guess let me rephrase that. I think there are other high quality companies out there that I could buy that are more attractively valued. That's how I want to word it. So that's my take. And kind of what I'm looking for with this one is, I jump in the 40s, not like high 40s, but if it got down to 45 or below, 45-ish or below, I would start dollar cost averaging into it. I'd bite the bullet. I would, because it is, I think it is worth paying up for a bit, but I don't think this much. I think what it would take for this one to come into buying range is some sort of pullback in the market. And at some point, I can't help but think, at some point, I think we're going to see it. I don't know when. I don't know how long it'll last. I don't know how aggressive it'll be, but things have been pretty dang good for a pretty long time, and it just, I don't know, it can't stay that way forever. So I think at some point something's got to give, and when it does, Rollins is like, I got my sight set on that one. So that's one of the big ones I'll be putting a lot of money into. Okay. Let's keep going. Let's go through one more, guys. We'll go through one more stock and call it a day. So yeah, okay. So this is a good one. I don't think we've looked at Ford for a long time. Emdo says, shameless request again to review Ford. Has been appreciating and has been a great dividend and have a strong roadmap for the next few years. So real quick, on that note, would you tell us a little bit about the roadmap? Because I'm not, I don't keep too close to tabs on Ford. I typically, I'm not that interested in the car companies as an investment, but yeah, if you could share some insight on that, that'd be helpful. Ooh. Okay, so let's check out Ford. Let me jump over to the screen. Bear with me, guys. It's not cooperating. There we go. Okay, I was pushing the wrong button. It was a user error. Okay, so Ford. Ooh, very low snap score. You see that? Okay. So let's start here with the share price. Last month, not much movement. Year to date, very solid performance, up 30%. My dad, just as a sidebar, my dad really likes Ford. He really likes the stock. I know he's got a position in it. Two of my brothers have positions in Ford as well. So they've done pretty well on that one, I know. And also, Emdo says they have a strong EV plan and have a nearish term goal of creating the most affordable entry-level EV truck. Okay, nice. Thank you for sharing that. So over the last year, the stock is still up 16.14%, still not too shabby. And the valuations, it's interesting, right? 15 PE ratio, not too bad. Excuse me. Free cash flow yield is very high, 21.7%. Now, a lot of red flags, 8 red flags, very low snap score. Okay. Yeah, so just some quick thoughts on this. I mean, we'll take a look at the growth. The profitability, low profitability doesn't really surprise me. I mean, they're manufacturing some pretty heavy equipment, and that's going to be very capital intensive. Not to mention they have to change out what they're making every single year. When they update these models every single year, that's going to slightly change things, and that's going to cost money too. So it doesn't surprise me to see the margins are going to be low. I'm sure that they're, funding a lot of this with debt. So it doesn't surprise me to see the debt a bit higher as well. So anyway, let's just scroll down and see what we're working with here. Okay. Yeah, so the sales definitely took a hit during the pandemic years, which probably shouldn't surprise any of us. 2020 and 2021 were pretty weak, but excluding those, 2019 to 2022 was pretty flat. They actually returned to growth in 2022. And since then, it looks like revenue has still grown pretty consistently. And actually, the 5-year revenue CAGR is pretty nice at 9.8. But over the last 10 years, it's 2.4. So excluding the pandemic years, I think the sales growth looks pretty solid and consistent. With that said, there's a few years here where it looks like the earnings have been negative or basically nothing. And so that's not great. But even so, like the general trend, if we were to draw a trend line, over this last decade, it would be down. So I don't personally, how do I say this? That gives me pause is what I'm trying to say. I don't really like the way this looks. I don't really like the way this looks either, because I think the general trend is down as well. I probably wouldn't invest in this company just based on these right here. I think from a dividend standpoint, that makes things a bit difficult, and it would, without even looking at the dividend stats, that would make me a bit concerned for the consistency and sustainability of the dividend. But let's continue scrolling down and see what we're at here. So, margins have been interesting. There's been a couple periods where the gross margins have really suffered. Going into 2020, I mean, in 2020, not much of a surprise, but then they bounced back up and since have come back down again. So I think that's a bit funky. Yeah, I don't know. This is just there's nothing jumping out to me here so far that makes me think, this could be an interesting investment, other than the fact that Ford is a very recognizable and iconic brand and company. But with that said, I would like to say, go back over here. I would like to say, when it comes to buying cars, typically people are not, I mean, there's exceptions for sure, but typically people are not loyal to a brand. Like once you buy one Ford, you're not very likely to only buy Fords from then on out. If you go and buy another car, however many years down the road, you'll likely explore your options. You'll look at Ram trucks. You'll look at Toyota. You'll look at all the other truck companies or car makers. You'll shop around and see what jumps out to you. You're not going to be that loyal to Ford just because you owned one Ford in the past. And so even though Ford is a very recognizable brand, recognizable name, and people will always have a need for trucks and obviously automobiles. The brand doesn't really, I don't think the brand doesn't really serve as a strong competitive advantage, because I don't think it's something that is enticing customers to be loyal to them, if that makes sense. I don't think there's any brand loyalty there, even though it is recognizable. Hopefully that makes sense. And that's not exclusive to Ford. That's probably true with most, if not all, car companies. Um, Now, anyway, going on, looking at the interest coverage, very low. Okay, 4.6 in the trailing 12 months. But still, like if we look at the 5 and 10 year averages, they historically have pretty low interest coverage ratios. So that's normal for this company. But still, like like I said, I like to see that they're more able to pay their interest. And so that's another thing that for me, it probably would make me not interested in buying it. Now, as far as the dividend goes, you are getting a high starting yield right now at 6.7%, let's call it, above both the 5 and 10 year averages. Um, but the dividend has really been all over the place over the last decade. It's had its ups and downs, but there doesn't look to be any consistent growth or sustainability. So I think it kind of makes it a bit unpredictable as far as the income goes. And if you are someone who is, I guess, if you are someone who's in retirement or uses their dividends to cover their expenses or fund their lifestyle, this would be a hard sell. I don't know why aside from the higher starting yield, I don't know that you'd want to own a stock like this that's so up and down as far as the dividend. Yeah, payout ratios are a bit sketchy as well. So I don't know, and also very low returns on invested capital. Like, man, I don't know that I've ever seen lower, actually. So I don't know. There's just nothing that really jumps out to me about this company aside from the name. I think that they probably deserve this low snap score, and personally speaking, it's one that I would. It's one that I don't have any interest in owning. Okay, so let's see what else here. Yeah, so thanks for reviewing that. I have not committed, but was curious about it. Appreciate your videos. You've been influential. Oh, nice. Well, that's awesome. I'm glad to hear that. Jay says they have a special dividend at the end of the year. Okay. And Tim, I'm sorry, man. So Tim wants us to check out Mitsubishi. Yeah, let's do that. We'll make Mitsubishi the last one. We're gonna wrap it up with this one here. I don't know that I've ever looked at this one. I'm not even sure what the ticker symbol is. Okay, it's on the OTC. Found it. So let's see what we got here. Okay. Okay, so we do have some information. Sometimes with these OTC stocks, I don't know if it doesn't always give us all the info, but anyway, this is Mitsubishi. Very strong performance, right? Over the last month, up 9%. Year to date, it's up 50%. Not as many red flags as Ford, only 3. The snap score is a bit higher, but not by much. Okay, so we're seeing very high growth. Profitability is a 1, just like with Ford. No surprise. Debt's looking to be a lot better. Dividends and buybacks low, capital efficiency low. Okay, so not the best snap score, still 4.4. Yeah, but it does look like revenue's grown pretty well. It's had its, it's a little bit choppy, but the general trend is growth. Nice CAGR over the last 5 and 10 years. Earnings per share is a bit lumpy as well. It doesn't look like there's been a whole lot of earnings per share growth overall, though. Definitely not consistent. Free cash flow per share, that's a different story, though. This is consistently, seeing some growth, at least since 2020. 2023 was a great year. But yeah, this looks a lot better than the earnings per share chart. So that looks good. Margins, not too bad here, actually. Looks like they are increasing. Debt's looking good. This is looking good. So they took on a lot of debt in 2020, but they're since paying it down. They've really done a good job of paying this down. The net debt to free cash flow has really come down as well. So I think that's looking good. That's looking a lot better than it was. With that, though, the interest coverage is still pretty low. In 2024, it was only 3.5. So I'd like to see that higher. And this is way below the 5 and 10 year averages. I think the averages look a lot better than it does in the most recent year. So I'd like to see that a bit higher. Yeah, it looks like the dividend's relatively new as of the last couple of years, but so far it's grown very well. Nice starting yield too, 3.15%. You know, you're getting double-digit yields over there, or excuse me, double-digit dividend growth rates over these last couple of years, and the dividend is very well covered here. Very well covered. Yeah, so I think as far as car companies go, Mitsubishi is looking a lot better than what we saw with Ford. Do they do other things besides cars, or is it just cars? It's a conglomerate, so they do other things. Natural gas, okay. Wow, so they do a lot. Huh. Yeah, I didn't realize it was so I didn't realize it was so diversified in what they do. Huh. Very cool. So yeah, it's okay. Um, they build a lot of things. Yeah, it looks like it. Okay, guys. I think this is a pretty good place to wrap it up. We've been going on for an hour. Let me know real quick before we go. Couple of things. Number one, do you like this format? I mean, we do this in the dividend happy hour as well. It's a bit more Q&A versus like live stock research. But let me know if you like this format of live stream of video. Give me your feedback. Number one. And number two, I also want to know, what have you guys bought this week, or what are you buying this week? What stocks are looking good out there to you right now? Let me know. Let me know those two things in the chat. Okay. Steve says it's great. Sir Dude Man, I dig. What else we got? Yep. Okay. Ware's been buying Coca-Cola. D's Div's been looking at Hess Midstream. Christian digs it. Sir Duderman's buying TJX. Chris is buying GLDM. Tim just sold out of Amex and bought Visa. Nice. Love me some Visa. Jay bought Amazon and UNH. Yeah, man, SPYI. T has been good lately. It sure has. Yeah, Jackman likes the format. Procter & Gamble's a bargain. Yeah, it looks to be that. It's headed that way for sure. Suzuki Man's looking to increase his Pepsi shares. Yeah, Law says, I like the stream and buying Amex and maybe QQQ. Nice. Ooh, Korean Cardboard's had to pay for 2 dental crowns. Man, I'm sorry to hear that. Oh, cool. I'm glad you guys like this stream. Man, it's like I said, it's been a couple weeks. I feel like it's always this way when you take some time off from live streaming or talking to a camera. There's a little bit of, you have to get the rust off a little bit. Yeah, Mdo, I appreciated this video format. Bought Walmart and keys. Okay. Nice. Well, thank you guys. Thank you guys all again so much for tuning in. I hope you had fun. I certainly did. Fun little midweek stream. I don't know if we'll do this once a week or I won't plan on doing it once a week. It's not going to be set in stone, but you can count on me doing this every so often. Whenever, like I said, whenever I get the itch, whenever I feel like there's some downtime around here, I'd love to hop on and do this with you guys. And once again, if you guys want to use Snapstock for your own stock research and analysis, there's a link to it in the description of the video. I will put it in the pinned comment as well once I'm done doing this. So, yeah, see you Friday. And I will be live streaming Friday. We'll be going live for the Dividend Happy Hour Friday at 5 p.m. Pacific time. So yeah, once a month is fine. It could even be more than once a month. It's just going to kind of be whenever it fits into the schedule. But it was fun. It was fun just to hop on here and and look up some stocks with you guys. So thank you again all so much for tuning in. I hope you all enjoy the rest of your day and the rest of your week. And I will see you on Friday. Be there for the Dividend Happy Hour. I'll see you guys then.